Hello and welcome to this week's instalment of Nucleus Investment Insights. And today's presentation is entitled, Is Australia's Housing Rebound a Bull Trap? I won't go into it any further because we're going to be spending the next half hour, 40 minutes covering off on exactly that topic. But I am, as always, joined today by our wonderful team of IT savvy people. We've got our Chief Economist, Leith and Onselen. G'day, Leith.
G'day, Tim. G'day, everyone.
We've got our Head of Investments, Damien Klassen. G'day, Damien.
Hi, Tim.
And our Chief Strategist, David Llewellyn Smith. Hello, David.
Hi, Tim.
Fantastic. Let's jump into it. So the agenda today. So we're going to be looking at, or beginning with, reasons for the strong bounce in housing prices in Australia, of course. Moving across to rising economic risks, both domestic and global. We'll then face the question of the day is this Australian housing lift actually a bull trap? We'll then cover off on three scenarios we expect maybe in front of us in the short to medium term, and then of course round off, as we always do, investment implications on how we run money every day here at Nucleus Wealth and the MB Fund. So with no further ado, I will hand over to Leith on our first topic of the day, housing rebound and the state of play. Leith, take it away.
Thanks, Tim. Look, first of all, I just want to say that this presentation is based on our third quarter subscribers report. So if you want to get a more detailed input about what we're talking about, and you're not already subscribed to MB, do so. You can read that report.
Nice plug.
Thank you. Shameless plug. Look, the CoreLogic results were just released last week, and obviously we've got a very, very strong housing rebound going on here. After nearly 2 years of housing declines, over the last quarter, capital city house prices have risen by over 2%. And that's been driven by Sydney and Melbourne, as always, the bubble centres, which have risen by about 3.5% over the September quarter alone. So that's a very strong rebound in price terms. If you analyse that, it's over 12%. Now, this has led to a lot of people, Chris Joy, Louis Christopher, a whole bunch of other people saying, the boom is back, baby, the boom is back. And also, we've also got the Treasurer, Josh Frydenberg, Scott Morrison, all out there spruiking that rise in house prices, a 10% rise in house prices leads to a 0.5% increase in GDP. This is great for the economy. This is what Australia needs to get back on track. This is what we need to, for the economy to recover. Now, if you flick to the next slide, Tim, this housing rebound has been engineered by policymakers and the government. There's no doubt about that. In the week before the federal election, when the coalition obviously had their very surprise election victory, Scott Morrison signalled in no uncertain terms. He came out and said explicitly that he does not want house prices to fall, and we want house prices to go up. And he announced a first home buyer deposit subsidy scheme, which effectively will allow first home buyers from 1st of January next year to buy homes with a 5% deposit. On top of that, obviously the election happened, the coalition got their surprise result. Labor's negative gearing and capital gains tax reforms were scrapped, which were expected to knock house prices down by potentially another 10%. And only 2 days after the federal election was held, APRA came out and got rid of its interest rate floor. So previously APRA required that lenders, ADIs, that it regulates, had to assume that borrowers could repay loans at a 7% interest rate, but it was really 7.25 because there was a buffer above that. It got rid of that mortgage buffer and effectively said that lenders only have to pay 2.5% above their prevailing mortgage rate. So what this meant was that as the RBA's cut rates, it's cut rates 3 times since then, the serviceability floor just keeps falling. And it's keeps falling, and what that means is that the lenders are now able to extend larger mortgages to more people, therefore higher house prices. We've also, as I just mentioned, the RBA's cut rates 3 times. We expect more of that to happen. The Australian Securities Investments Commission, who was taking Westpac to court for breaching responsible lending rules, effectively Westpac and all the other major banks have been using this relative poverty measure called the household expenditure measure to estimate borrowers' expenses. This was set at a really low level. So what it meant was, by using this default poverty measure, they could lend more. ASIC was challenging that in court. The Banking Royal Commission said that was inappropriate and that needs to be scrapped. But ASIC actually lost that case in court. So that's another red rag to a bull for the lenders that, potentially it's back to the races. And just last week, again, we got Frydenberg and Scott Morrison come out and basically say that we do not want excessive regulation to crimp lending and that we need to lend more. So we've got effectively got this entire, Politico housing complex, or as Dave likes to describe it, the Fasco housing complex now.
Fascio, yeah.
Fascio, sorry. Fascio housing complex has basically been dictated from the top that house prices must rise. We must lend more, driving this rebound. But this rebound, so obviously in the short term it's very bullish, but we see much, bigger risks over the medium term, which I guess we'll get into now.
Okay, sure. Just before we do, and just as a shout out to anybody who is watching in live, that of course make use of the question box at the bottom of our live presentation. And for those that are listening on the podcast later, the slides, of course, as always, are available and a link in the show notes. I've got a quick question around some suburbs in the Central Coast, but perhaps we might hold that over until we've covered off on the overview. So just bear with us, Val, from the Central Coast. Domestic risks rising.
Yeah, so we've got this situation where effectively the coalition wants to try the old Howard government trick, whereby it tries to run budget surpluses, etc. It effectively orders or forces the RBA to cut rates, and then cut interest rates, and then that encourages households to leverage up, bid house prices up, and then that gets consumption spending, dwelling investment, etc. Rising, but there's actually a lot of barriers to stopping that happening or successfully this time around. So what we've got here, we've put up a chart which sort of like is the overview of what drives Australia's economic growth in terms of final demand. So we've excluded net exports here because that's not the domestic economy. And there are effectively 4 growth drivers. So you've got consumer household consumption, which is over half, that's about 55%. You've got government investment, it's about a quarter. Business investments, about I think 12%, and the rest is dwelling construction. Now, final demand's been falling quite sharply over several quarters. It's actually running. It was running at 1.7% in the last financial year, which is basically population growth. So it's almost going nowhere, and it's got a very nasty trend. And we see it actually getting a lot worse, and probably heading towards 1%, which is sort of the lows of the 2013-2014 period. And that's based on basically these 4 growth drivers spluttering. We thought we'd just give a quick overview of each of these and basically what is happening to the Australian economy when you break up these 4 components.
Okay, sure. Yeah, let's jump into them. So we've got dwelling investments first.
Yeah, now dwelling investment's not the biggest driver, but it's also it is very volatile. So it does affect growth incrementally as it goes up and down. There's no surprise that the dwelling investments started to fall, given we have this massive run-up with apartment building and all the faults and everything that's happened. But dwelling approval, so dwelling construction is already down about 10% if you use, it's not shown in this chart, but it's already down about 10% if you use the quarterly construction data. But the bigger problem is that dwelling approvals have already fallen 30% from their peak. And anyone who's watching this live can see that's a very nasty, it's a nasty slope there, and obviously completions and commencements follow approvals with a long lag usually because it takes about 2 years to build an apartment. And the reason why this matters is we've got 1.2 million Australians who are employed in construction, and that's about 9% of the Australian workforce. So it's pointing to some, probably 2 years of pretty sharp dwelling construction falls. So we're expecting that to obviously subtract from jobs and growth, and we're talking maybe 100 to 150,000 workers there.
Yeah. Now, I haven't seen, Leith, anything from the government supporting dwelling construction in particular.
No, in fact, if anything, it's going to get worse because of the high-rise construction concerns. So anyone who's been paying attention to the news would have seen all this Opal crisis, Mascot, etc., where basically a huge share of high-rise apartments that have been built in the last 10 years basically got structural faults of cracking or flammable cladding. So that's actually leading to, buyers being very wary, and there's court cases being played out, etc. And we're actually expecting a lot of developers to go bust. And if anything, this construction chart's going to get a lot worse.
And so I think, and as far as I can tell, while so that's sort of flowing through into the lending as well. So banks are going, yes, we want to lend as much as possible at the moment, but we'd prefer not high rise, and that's where all the supply is coming on. And so you sort of got that mismatch about now you're chasing, small houses on small blocks of land are just being the real thing that's really being bid up.
And more than that, established housing. So so obviously, people want to shy away from this high-rise stuff. They want to buy, established housing or potentially new low-density housing. But it's a nasty equation, effectively. 1.2 million people, and it's not shown here, but we've got in the special report that at the same time this is happening, the pipeline of infrastructure is actually starting to fall as well. So we're not expecting an offset from infrastructure either. So that's a bit of a concern. Yeah.
So in terms of getting an employment, I guess where's the hope in the employment? And I guess one hope would be that house prices start rising and developers go, this is fantastic. I've got to go out and start developing as many land and house packages as I can, and convert that sort of 20 years worth of. Most of them have 20 years worth of inventory sitting on their books. So in theory, they could roll that out relatively quickly if the lending was there. On development, but I don't think it is at the moment.
They could on the low-rise stuff, but remember that the
high-rise stuff takes ages.
Yeah, the high-rise stuff, and the high-rise has actually been the marginal driver of the huge run-up in dwelling construction. So the detached house construction never actually rose that much from its historical average. It was all primarily in the high-rise. So even in theory, if the high-rise developers would come back out again, it's going to take 2 years to feed through, because it's two years lead time to really filter through to construction. So I guess in the immediate term, or the next 2 years really, we're expecting pretty hard dwelling construction crash, and what happens after that, who knows. But that's something we'll probably be talking about in about a year's time.
Okay. Anything to add, Dave?
Well, I guess the broader framework of that is that, as Leith mentioned, the government's intent on replicating the Howard model for growth, and what this is suggesting is that one of the key follow-throughs you get from rising house prices is dwelling construction, and that creates activity and jobs, etc. And this time around, you're just not going to get it. It's at least for the next, as Leith says, probably 2 years it'll actually fall, and so that represents a very different formula to what you got under the Howard years, and suggests that the entire enterprise is rather ill-conceived, actually, but more practically speaking, just means that they will really struggle to get momentum.
Yep. And the other issue is obviously we had 70-ish% household debt to GDP, and now it's 110 or 115 or whatever. So we've gone from the back a long way. You can play the trick of back gearing up. But there's only so many times you can play it before you're like, well, everyone's geared.
Yeah, and just to draw on Dave's point quickly, like to draw an analogy, it kind of parallels what's going on in the commodity market. So obviously we had the massive mining boom, but that was the one that went up to 2012 was basically a commodity price boom, but also led to a mining investment boom. And that's what filtered through to the workers and gave us employment and income growth. Yep. Currently we've got commodity price boom without the construction boom to go with it. So it's sort of like it's an empty boom if you're an Australian worker, and that's kind of what the same kind of situation we've got with the housing market. Yeah.
Is there a place for this infrastructure spend? Do you think?
Absolutely, there is, but there's none coming.
Yeah, right.
It's actually falling.
It's falling. There's a big pipeline. It's just that the nature of public investment, well, actually investment in general, is the rate of change that matters. It's not the quantum or not the total. And so, because it's run up very strongly for the last 2 or 3 years, if you just take your foot off the pedal a little, it just stalls out, and it may stay at a high level, but it doesn't add to growth. And so it adds no jobs. And as it happens, because the pipeline's a bit lumpy, it looks like it's actually going to taper off for the next couple of years before it picks up again and holds on to this kind of high plateau.
Probably because of the NBN, really, isn't it?
Yes, the big one is the NBN rolling off, and so it means a lot of these new transport projects that are being run by the states are simply being offset by the NBN rolling off. Yeah. And the NBN was an extremely labour-intensive business, more so than transport, and so it doesn't give you a big jobs pump at all.
And it was national as well, I guess, wasn't
That's
it?
right,
Yeah, not localised.
Especially tunnelling. Tunnelling is very capital intensive and not very labour intensive, whereas digging ditches to stick telephone lines in, or even doing normal roads and roundabouts and all that type of stuff is relatively intensive.
Well, anyone who put humans. The NBN on knows that they've been visited by about 6 or 8 different people.
Mate, there's always guys in orange vests out the front of my house digging.
That's right.
Trying to fix up the mistakes.
The process just folded on itself about a million times.
Very well serviced.
Yeah, that's right. And yes, as Damo says, a big fat tunnel just doesn't do that.
Fair enough. We'll roll across to the Australian consumer, and it's on life support at the moment.
Yeah, so now this is I guess the big one in a lot of respects, because as I said before, household consumption drives about 55% of the economic growth historically, and it's actually running well below historical averages, and it's actually household consumption growth has been falling. So it's
and this isn't per capita, is it?
No. This is just the annual growth rate.
So you're negative on close to zero.
That's the average, I think.
Yeah. So the red line's the average, which isn't zero, but that's the historical average.
The blue line, take out 1.5-2%.
Yeah, it's very
population
weak.
growth is roughly about just above zero.
Yeah, that's right. So it's very weak, and it's actually falling. And the big hope, and this is the I guess the big hope. And this is what Josh Frydenberg was referring to when he says 10% house price rise pumps GDP by 0.5%. Is that you get this wealth effect. So generally, historically, when house prices have risen, people feel wealthier. They go out and spend.
Equity, mate.
Yeah, that's right, equity, mate. And they go and spend more, and then you get more household consumption. The problem is, though, there's a lot of reason to believe that this isn't going to happen to anywhere near the same extent this time around. And Phil Lowe's the RBA governor's made this point last week or last couple of weeks. And that's because, as Damien mentioned before, household debt is already at very high levels. So we've just hit the highest record on level, 190% of disposable income, second highest in the world. And there isn't actually that much scope to keep leveraging up, especially when we've had 7 years of household disposable income per capita basically flatlining. In fact, it's slightly lower today than it was 7 years ago. So we've had no income growth. Households have been borrowing anyway. They're already leveraged to the eyeballs. The household savings rate has already fallen to the lowest level since 2007. So it's been falling. And that's obviously unsustainable. They can't keep borrowing forever when you've got no income growth to then boost consumption. So it's already sort of hitting its limits. And what this means is that there isn't actually a lot of upside to juice consumption from here. And if anything, they might be able to engineer a little bit of a turnaround, but it's not going to be enough to juice the economy much.
And you can see on that chart, the 2012 to 2000 when that finished, 2012 to 2017, that sort of house price boom didn't really show up on the consumption side this time around.
No, that's right.
Certainly did the prior times, but
it'll be even weaker this time. And
there's another indicator too. I mean, anybody who follows this sort of data would probably notice that mortgage credit has fallen. The stock of mortgage credit debt outstanding has actually fallen to the lowest level on record in both quarterly and annual terms. And what that tells you is that households are actually taking their tax cuts, taking their interest rate reductions, whatever, and they're using it to pay down debt.
I was just going to say,
more than taking out new debt.
Yep.
So or deleveraging, if you want to, in a certain way. So that's just another sign that not going out and spending, not buying their TVs, cars, whatever. They're actually paying down debt.
Okay.
There's another component to this as well, in reference to the previous chart with the dwelling construction crash. A lot of the consumption that comes out of a housing boom, typically you get the dwelling construction that follows on, and then there's a whole lot of household goods that people have to buy for these new homes.
Yeah, absolutely.
And you're not going to have that this time. In fact, it's going to be falling as well. So that also retards any kind of flow through, into consumption or a consumption lift. So we're expecting a pretty muted rebound despite their best efforts to juice prices.
Yep, sure. Okay, good point. We'll roll across to the business investment.
Yeah, so business investment basically isn't doing much. It's just running around average levels. But both the NAB business survey, the ABS CapEx survey shows that it's going to grow slowly. 1% or so per annum, which is not. It's really just treading water. So it'll add a tiny bit to growth going forward, but not much.
I think the big point with this is, for anyone who's not just listening in and can't see the chart, that we've come through this period where there was a huge spike in business investment in 2012-ish. Between then and 2017, fell quite sharply, and that's all the mining boom, and we've sort of just made it back now to sort of more normal levels. And it's not the mining side has stopped detracting, or I guess there's still a few more to roll off, but most of that detraction sort of has fallen away, and so now you've got to say, okay, now the rest of the economy is what needs to do it, but you've got the construction falling away at the same time, and then
consumption
and uncertainty, and so the question is what's going to get people out there to say, we need to get out there and really reinvest in projects. And obviously China keeps throwing more and more investment at its side to create lots of supply, and so it's sort of it's tough to see what's actually going to turn the business investment around at this point.
Yeah, mining is adding now rather than subtracting, based on the price boom that we've had in the last couple of years. But most of that is really just mine substitution. So it's not...
And plant and equipment as well.
Yeah.
There's a lot more in the plant and equipment side than what there is in the new mines.
Yeah, which is important.
Just imports anyway.
But it's also the part about if I buy a new tractor because I buy a new truck or something because I've got a lot of cash at the moment, that obviously doesn't flow through to... the difference between that and starting a new mine and then going, okay, I've got to spend for the next 3 years. I've bought a new truck, that's it.
Look, there is some, but it's modest, and it's about to run into some pretty serious global headwinds anyway.
Which we'll get onto very shortly.
Yeah.
Just a quick one on that as well, while we're on the business topic. I was reading something the other day, talking and going back to credit again, but typical small and medium enterprises use their own house as collateral to borrow and spend to build their businesses, and there's apparently some friction now where banks are going, well, I know you're borrowing against a real asset, but you're borrowing for a business purpose, and so it's sort of falling foul of the regulations between of predatory lending, essentially, where they're sort of saying, okay, well, you're borrowing but you're not exactly earning. Have you come across any of that?
Nah, but what I will say is it's very hard to get a business loan if you don't secure it with a house, or something like
for small businesses.
We experienced that a couple of years ago. It's a joke.
But I think that
I mean, our experience basically is if you don't have a property, forget it.
Yeah.
Like they're not interested in your P&L or your balance sheet. They're only interested in your property, your personal property. Like nothing to do with the business whatsoever.
No.
And that's largely, I think there's arguments that there's a lot of the Australian banking has lost that. They've lost that ability of how to service small customers, because small businesses, because they basically have just lazy. They've just said, much easier if you've just got a house, great, bang, I'll
collateral.
take collateral on that and off you go.
And the model works.
The other question, sort of raising from some of these Royal Commission one, was about the know your client rules and whether that's actually expanded to cause issues for some businesses as well. And there are indications that certainly in the first instance that because banks didn't know their client well enough, they actually needed to go out and do more work on the businesses. The question is now whether with the Treasurer and Prime Minister exhorting banks to get out and lend, whether they then start to roll back and go, well, maybe we don't need to know our client that well. Maybe, as long as nobody's going to jail, let's shove as much debt.
Well, and could that be an answer that could be done through a regulatory way then, where a certain percentage of a bank's loan book needs to be in a certain sector? There was something in Germany where it's like that as well, where they quarantine off banks that can only service certain parts.
Unfortunately, the global bank capital rules, the Basel II capital rules, Basel III soon. They prioritise housing lending over business lending. So basically, if you're lending to a business, you get charged 100% risk rate. So you have to hold 8% capital. But if it's a house, it's 0.25. So 2%. Is the standard. So So those global capital rules actually encourage housing lending over business lending.
Okay, yeah, interesting. All right, very good. We'll roll across to the saving grace, the public teat.
Yes. Now this is the public sector is usually 20-something% of the I think it's about a quarter of Australian growth, typically, historically. But in the last financial year, so the 2018-19 financial year, it actually accounted for 62% of Australia's growth. So effectively, Australia's economy has been on public sector life support.
It was 100% of labour market growth.
That's right. Yes. So it's even more when it comes to employment, and it's a very simple reason. They've been obviously building the NBN, NDIS has had a massive rollout, et cetera. But those two things are both ending. The rollout's ending. Now, it doesn't mean that there's going to be no more spending on it. It just means that, as Dave said earlier, if you don't spend more this year than you did last year, you don't get growth. Yeah. So effectively, it's running way above average levels. It's run up heaps, and it's sort of hitting a turning point now. So we can't expect as much spending from government going forward to keep driving growth. On top of that, which Dave will get onto in a second, the commodity prices and the terms of trade are starting to turn too, and what that means is that we're basically heading into a budget deficit again, and that'll smash national income, etc., and make it harder for governments to keep spending to support the economy. But
we've also got quite a bit of public consumption austerity at the state level.
Yeah, that's right.
After the housing bust.
And stamp duty cuts.
And even though there's a price rebound, the volumes are still really low, and so there's not going to be a huge rebound in stamp duty anytime soon. And so although the states are sort of recycling assets as quickly as they can, building things and selling them off, there is austerity on the other side of their consumption contribution to growth, so it's also going to be more difficult at that level.
So basically the upshot is, so you've got these four drivers. You've got dwelling investments falling, and that's going to subtract from growth. Business investments going to add a little bit.
Consumer?
The consumer's going to keep adding to growth. It always does, but it's going to be less. And the public demand's going to add to growth, but it's going to be a lot less as well. So this is why we sort of think that it's probably final demand's growth's going to fall to about 1%, which is kind of where it hit in the, I think, 2013-14 troughs. So basically negative in per capita terms, and just a slow grind for the economy, which means rising unemployment, and this sort of, I guess, a glass ceiling on the housing rebound on the domestic economy side after this pent up demand, and this little mini bounce has flown through. But I guess we'll pass off to the global risks to Dave.
Certainly. Okay, so external risks. We've got three.
Yes, we do. External risks.
So there's many more than that, but three big ones.
Three the ones we want to talk about today.
The three big ones, yeah. US-China trade war, which I'm sure everybody's familiar with. This is a structural change. There's some prospect of a cyclical improvement with a deal. Very big meeting coming up in a week or so in the US with Li Hui coming over from China. But it's very much a structural change. Even if there's a short-term deal done, it'll largely be PR, we think. And so you'll see this friction in the US-China trade settings more or less permanently. But obviously also a very high risk of it getting worse. Even this week we saw Trump mulling kind of new capital restrictions on how US businesses can invest in China and how Chinese can access US capital. And so there's obviously very key risks in terms of that getting worse. And that bears upon Australia in any number of different ways, but probably the key one is China slows as global supply chains de-risk and pull out of China and look more to Southeast Asia or Mexico, etc., into areas where they don't have to deal with these political risks. And that has a flow-on effect, obviously, into bulk commodity prices. Now, the second risk we've got there is the Hong Kong insurrection, which at the moment is looking quite nasty, with the 70-year birthday celebrations for the People's Republic, and the honkies taking the opportunity to rain on that parade. We've had a student shot, first time of sort of live ammunition casualty has happened, and more protests on the back of that. It's also sort of seemingly inexorably making its way into the trade friction with the US. Trump has avoided that, but the US Congress hasn't, and has started to actually seize the mantle from the president on, how the trade war is negotiated in a context of Hong Kong freedoms, and so that's not a pretty picture. The implications for that in terms of the trade war, of course, is that if the CCP is forced to stomp on Hong Kong, at this point it still looks like it's a slow bleed until they lose their temper. Then this de-risking of supply chains will just turn nuclear. I think for an entire generation, business foreign direct investment into China will just stall, and in fact reverse a lot. And
that's if they crack down.
If they crack down, and so
and we already have this view that because of the trade frictions and the whole rise of sort of gets bringing to the forefront about the amount of cheating China's been doing and the amount of spying and taking of people's data, that we've already got the view that we're already in a structural move away from China, sort of 10, 20-year move where companies will move their supply chains out of China. I think there was a survey out, it was probably a little bit selective, but sort of had something like 80-something% of companies that are in China are looking to move their supply chains away from China over the next year.
Sounds smart.
And so it's not going to happen, turn overnight, but it's just this gradual, slow bleed already. And I guess what David's saying is if you get a crackdown as well, then it's sort of lights out now. That whole process accelerates.
It's lights out. I mean, something like 80% of people that invest into China base themselves in Hong Kong, of multinationals, right? So I mean, if they crack down on that, the whole model will just fall apart.
Yep.
So that's global recession, I think, as a certainty, if they're forced to crack down on Hong Kong, and I still don't see an easy way out of it. So those two risks kind of come together in an alarming way. And then, around the other side of the world, we have Brexit, of course, where Bojo is doing his best to exit the European Union, and I could spend the next 4 hours talking about British politics, but I'm not going to because it's an absolute mess. But it still looks like a hard Brexit is a distinct possibility, even if they have to go to an election first. Then the polling is still very much in favour of Tory/Brexit parties.
Okay.
So that's. We've already basically from the first two risks we've already had a flow onto Europe because Europe's a very externally driven economy.
Yep.
So as its exports have fallen on the trade war and frictions, Germany has stalled out and Europe's already kind of close to recession. And then if it's hit by a hard Brexit, then I think we can guarantee most of Europe will go into recession. And so again, you get these. This is. Even without a Hong Kong blow-up, you've got a circumstance of a death of 1,000 cuts in the external environment. And for Australia, that obviously means less demand for commodities. And so we see next year, and this has already started happening, the key commodities of iron ore and coal and LNG, actually, all of them getting thumped. So, I mean, coke and coal's already down 40%, iron ore's down probably 30, but has another 30 to go. I think coke and coal will keep falling. Thermal coal's down the same, and is also still falling. And the falls so far have really just been kind of resolutions, just the leading edge of weakening demand, but most of it's been the resolutions of supply side shocks, for especially iron ore and coke and coal. And so if demand really does take a hit, then there's a lot more downside in commodity prices. And so on this terms of trade chart we've got up here, I would see big downside, not to the depths of 2015 at this stage, but significant and material. And so we, having been through this several times over the last few years, we know precisely what will transpire as a result. National income will get smashed, budget revenue will dry up, and the surplus will turn to deficit. We obviously have this very deficit hawkish government, who are going to face quite a difficult political circumstance in having to reverse out of their very strong surplus rhetoric, and they've waited too long already. And as this develops, it's very likely they'll still wait too long. And when they do go, they're likely to go with tax cuts that will only enhance deleveraging.
Yep.
They won't spend, and so again, you've got quite a nasty kind of growth headwind for Australia in that. Mining investment, the little pulse we've got now would dry up, and all of that in terms of the housing rebound and what we were talking about with the consumer, it's all extremely negative for wages growth. You will see more unemployment, and wages growth will just simply fall away again back to the lows that we've seen, if not lower, despite because of population growth as well.
Yep.
And so, as Leith eloquently put it, the glass ceiling that sits on the housing rebound thickens up and maybe gets opaque and maybe turns into bricks, right? And you bounce off it. So I guess that's probably the point at which we could switch to our three scenarios.
Let's do that. Yes, three potential scenarios. We put this down as 50% probability of that base case being, some kind of moderate deterioration in the global economy, leading to this ceiling past which house prices can't really go. We call it, a 10% bounce before that kind of rolls out. That we're talking about Sydney and Melbourne here. Most of the other cities haven't moved that much. Yep.
And at that point, it's up for grabs, how bad those various things get, and you get into risk cases. But the base case is, with that plateau in place, it's difficult to see much more upside for house prices, and so you might actually start to see real price falls again. Not nominal, not like the correction we've seen, but more into a kind of grind lower over the long term, where you've just got no income in the economy. And that just could go on and on and on, because what we haven't talked today, all we've really talked today about is cyclical stuff. What we also think is that China is very close to or nearing, the structural shift in its development model to slower growth.
Yep.
And certainly much slower capex.
Yeah, much slower capex
and more services growth.
And so, then if you get into this circumstance where you're just constrained income in the economy starts to cap asset prices, that just rolls on more or less indefinitely. If China slows in that nature, commodity prices just grind lower and lower, and the terms of trade actually revert to mean. They fall below 2015, and you really are into a very long, very difficult kind of another lost decade for the economy and households and asset prices. And you have to, if it takes a long period, then it's manageable, but it's just not going to get returns on things like housing assets. So that's your base case. I mean, it doesn't sound a lot of fun, I know. Then you got your two risk cases, bearish 25 and bullish 25. Bearish, obviously, things go wrong in Hong Kong or something else happens, global recession, etc. Australia gets a spike in unemployment, and suddenly most of the eastern coast cities are facing the same scenario as Perth. They simply haven't escaped the negative equity trap of the recent correction before they've taken another shock, and so prices roll over and just continue to fall. And then we kind of canvassed the bullish upside case, which is the world managers just stumble through. There's some sort of PR trade deal, a kick at the can for the stock market, etc., and then you've got this defect crisis that's narrowing the options for home buyers. They're forced into a narrower gully of going for existing dwellings. That you've got the full faith and credit of Scott Morrison forcing everybody to take on credit. You've still got out of control immigration, and that launches another sort of mad bidding war in the housing market. But even that one, what happens when it gets to previous peaks? What did Sydney fall?
15.
15. So you'd have to get 18%.
Yeah, to get back to
the peaks.
Yeah.
You know, let's say you did that in 2 years. APRA,
then what?
Then what? Yeah, exactly. So I mean,
started.
APRA's going to have to do something. The debt metrics will be off the chart.
Interest rates will be lowest they can ever get.
There won't be any. They can't go lower. There'll be quantitative easing, and yet the prudential regulator will have to tighten, and it's just. It's a formula that just doesn't make a whole lot of sense.
Especially, it doesn't make sense with the fundamentals the economy's got.
No, definitely not.
So I guess you one more bull case onto that though is that Australian government debt is quite low, and so and we obviously have a government that seems hell bent on rising house prices at whatever cost, and so
bought them in the election, didn't it?
Yeah, but so that God knows what they could dream up in terms of how do we transfer more money from government debt into Australian houses.
Absolutely, yeah.
So
that's a more than fair point.
I guess we'll revisit the next report or the next one after that, and every quarter for the next couple of years.
Yeah.
All right, very good. And I'll drop in the question now from Val from CC. I only assumes the Central Coast. Hi all. Do you think there is a risk of a bull trap in some of the good suburbs of the Central Coast? And I guess this is loosely to any of the secondary cities outside of the primary ones. So Central Coast being 80 to 90 kilometres north of Sydney. I'm looking to buy my first home, and I notice there hasn't been an increase in prices yet in the Central Coast. But I guess you could probably loosely say Geelong would probably sit in that boat as well.
Yeah, well, I mean, I don't know that much about those markets, but I guess logically you'd expect them to follow Sydney, so with a lag. Yep. So because you get obviously the flight out of Sydney towards affordability and lifestyle change, etc. And it'll be the same with Geelong, with Melbourne, I guess.
Yep. Ripple effect.
Yeah, that's right, ripple effect. So obviously Sydney's house prices have gone up 3.5% in the last quarter. They're starting to take off. So you'd expect it to filter across to Gosford or whatever it is. I'm assuming that's where around about that area.
Yep.
With some kind of lag. But again, given that it's going to hit this ceiling at some point, well, then it'll hit the ceiling of the coast as well. Just with a lag as well, I'm assuming.
I'll just add one point, particularly for those satellite sort of cities and towns. I had a bit of a set to with APRA over the last few months because their investor mortgage data went all strange.
It did.
It suddenly added all these huge quantities, and the reason why was there was this categorisation change on investor lending for people who had second holiday houses, and they were being characterised as owner-occupier, and APRA insisted that they were shifted to investment.
Right.
And the implications of this, and I don't know how this will shake out, but they have done it, and it's in the data, is that the banks will have to hold more capital for these investment loans than they had previously for owner-occupiers, and they'll be charging higher interest rates for them as a result, and so that may weigh on prices in those satellite cities and towns. Not so much the cities perhaps, but I'm thinking of the Central Coast specifically because there is a lot of holiday business from Sydney in the Central Coast in particular, not so much Geelong in Melbourne's case, but maybe the other way down towards the peninsula. But in the case of Central Coast, that may be a factor. It's just something to watch if you're looking at the Central Coast to see how that shakes out, because the banks have pushed back against it now and said, well, we'll be hiking rates if you do this. And APRA has plenty of form of then kind of folding
capitulation
under pressure. But so far that's actually what is happening. So they'd have to change direction for it not to happen.
Okay, good. Yeah, great point there. Fantastic, and I hope that answered your question, Val. So we'll jump across now into our final slide, the impact of today's themes on investments as we run them in the portfolios at Nucleus Wealth. Who'd like to take off on what's currently happening and how we're employing what we've spoken about today in the portfolios?
So look, we feel as if I'm repeating myself as we have in several times this one, but 10-year bond rates have sort of fallen to below 1%. So we were pretty keen on using bonds as a bit of a hedge on some of these negative outcomes. Unfortunately, the yields have come down so far that we've gone from being very overweight to just very moderately overweight, and we're not sort of looking to add to that at this point. So we've been sort of cashing up and looking for opportunities. So markets have been falling over the last couple of days. We've got our target list of stocks and higher quality things that we want to target as stock markets tend to fall. But we're not sort of deploying that cash yet, and we're holding some of that cash in US dollars with a view that the Aussie dollar would be weak, which has been a positive for us as well.
Yeah, certainly.
So what we're trying to do is really just be mindful of how do you get protection at this point, and then finding that list of stocks and looking for various areas that we think will benefit. So there's a few, as examples, last month we were picking up a few companies that we feel are in sort of machine automation and will actually benefit as companies move their supply chain out of China and into say the US or whatever, where they'll actually need a lot more automation.
Okay. Thanks, Damien. Shooting off. No worries. Okay, no worries. Well, thanks very much. All right. Well, thanks guys for another terrific run through, and we're looking forward to next quarter's update and finding out how much of this is rung true. So. Very good. Okay, so moving on to what's coming up next week. So we've got Leith coming in again for the quarterly employment data. So Leith, do you think we should all be running off and getting our barista licences?
Yeah, so the ABS releases quarterly employment data every quarter.
Every quarter.
Surprise, surprise. Anyway, that breaks down the employment numbers by industry level. So we're going to look into that and see where the jobs growth is and where it's likely to go from here.
Yeah, okay. And it might not sound as exciting as Leith's. We probably could pick. I think we'll come up with a better headline before next week. But I guess the key part of this is that we really feel as if the construction part with the big decrease in approvals is where most of this case is resting. If it's a moderate falls in construction employment, then you end up with what we're looking at there. If they start getting out of control, then it doesn't matter if house prices are starting to jump. If you get some big falls in some really significant falls in those construction numbers that start flowing through the rest of the economy, then you start ending up in these bear cases. So that's the key thing we're looking at is the actual two key things. One is the supply of credit, but the second part is this is the employment side, and so that's what we're going to have a bit of a focus on next week.
Fantastic. Really looking forward to that. So that's same bat time, same bat channel, Thursday the 10th of October. And head over to our Nucleus Wealth live webinar page to check that one out. And of course, comment live on the quarterly employment data, or also stand by perhaps for a slightly sexier title for next week's podcast as well. So look forward to bringing that to you then. Cheers.
Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you with the next one. Cheers.